Well, welcome back to another rate and bond market update video. Today, we're going to talk about all things recession. What does that mean? How do we know when we're there? There's some interesting data points that will point us that direction. Now, am I rooting for a recession? On one hand, yes. On the other hand, no, right? On the more important hand, no, I'm not. Obviously, recessions are difficult on families, difficult for people to provide, to have stability in their lives. From that standpoint, no, I hope there isn't a recession. From the standpoint of let's get the Federal Reserve's boot off our neck as an economy and be able to reduce interest rates and get money flowing a little bit more freely. Yes, I hope that we do have a recession if that's what it takes. Obviously, I hope that we could get that result without a recession. But historically speaking, the only way the Federal Reserve typically reverses course is if they see things slow down, and that means a recession. So from that standpoint, hopefully it's a mild one, right? And something that lasts just a quarter or two, and we move past it during 2024. But let's talk about this a minute. I'm going to show you some charts here that'll be kind of fascinating to you, so you can kind of see the direction the country seems to be heading. And this is in the wake of the unemployment report, the employment report and unemployment report that we received last Friday, with the jobs numbers that were lower than expectations, and the unemployment rate that ticked up to 3.9%. We'll talk about that here in a minute. So I'm going to share some charts with you right now. First one is this savings rate. You may have heard that as Americans, we're not saving as much as we used to. This is very true. If you look back to February of 2022, the savings rate was 7.7% of our income was going towards that. Part of that may have been due, of course, to pandemic era benefits, et cetera, and extra cash that the government had put directly into the economy, that people were saving. They didn't have to spend quite as much of their own income because there was other income coming in. That has long since gone away over the past year and a half, so it's no longer there. In May of this year, the savings rate was 5.3%, dropped to 4.9% of average income. Then in July, down to 4.1%, August, 4%, and September was only 3.4%. So savings rate continues to fall. Not a good sign. That means people are stressed out a bit. What it means is people are trying to keep their same standard of living by dipping into savings. They've gotten used to spending a little more freely and buying more goods and services during the pandemic when they had more cash because of a lot of these government subsidies and other programs. And they're used to that, and they're having a hard time weaning themselves from that lifestyle. So let's see some more charts that'll illustrate the same thing. So scrolling down here, this is from the Federal Reserve. There's a Federal Reserve Bank in St. Louis. So this is St. Louis, Missouri's charts, and they manage the graphs and charts for the Federal Reserve System for the country, actually. So this is where this is from. You can look it up online and find these charts yourself if you want. But the personal, again, going back to the personal savings rate, as you can see, we had a personal savings rate somewhere in the 5 to 7% range for the year or so before the pandemic. And then that shot up to like 30% right away because people just stopped spending money and froze for a bit there in 2020 for a few months. And then that savings rate dropped, and then it started coming back up again in spikes when we received those checks from the government. Remember those checks we got from the government? They were kind of a surprise check, depending on family size, et cetera. That's what this reflects here. People started saving more of that cash. Then that started to fall off again when those checks, those government supports went away, and it's continually been going down. So people are starting to drain their savings with some of their expenditures. This chart below here shows you credit cards, right, and other revolving debt. So in this case, you can see that credit card debt and other revolving debt was increasing, albeit not real quickly, but increasing all the way up until the pandemic. And then people use some of that extra money to pay off their credit cards, which is a great thing to do. Unfortunately, by 2021, they started spending money again. And now you can see we are at all-time highs. As of September, total credit card debt is over $1 trillion in the United States, which is massive. Right now, as a percentage of average income, of average budgets, it's actually, believe it or not as high as it was 20 years ago in the 2000s. But as a total amount, an aggregate amount of total debt, it's the highest ever. So people have not stopped or not reduced much anyway up to this point their lifestyle choices. Instead, they've been using plastic and savings to subsidize it. So now let's look at this last chart. You'll find this pretty interesting as well. Okay, let's talk about the unemployment rate. So last Friday, unemployment rate was posted at 3.9%. Our low unemployment rate was 3.4% back in April. Okay, a pretty low unemployment for the last few years. Um, that was about, what does that mean as far as months to recession? What I'm showing you here is in the past, when we've had a low unemployment report, we've had an unemployment report that's low, but then about a 0.5% higher than that. So once we're a 0.5% higher than the lows, I hope I'm speaking clearly here, but once we're a 0.5% higher than the low unemployment point since the last recession, that has always been a very comfortable and very solid indicator that a recession is imminent in the next few months. So as you can see here, February 2020, our low unemployment rate was 3.5%. It was a 0.5% higher than that in March 2020. We had a recession, right? In May of 2007, our unemployment rate was 4.4%. And then it was a 0.5% above that. It was 4.9% in December 2007. 1 month later, we were in recession. In April of 2000, unemployment rate was 3.8%. It's a 0.5% higher than that in March of 2001. 1 month later, we were in recession. It's not always 1 month later that there's a recession. I mean, sometimes it's longer. You can see down here in 1948, it was 9 months later, but typically it's within a few months. So this would seem to indicate that now that we are 0.5% higher, 3.9, as opposed to 3.4, right, percent back in April, we might be a few months away, a month to 3 months to 4 months away from a recession, if we're not already in one. So yeah, that's the reality. And this is pretty reliable, right? This pattern is very reliable. So don't be surprised if you find out next summer that we were in recession Q4 right now, or Q1 and Q2 of next year. The government always lags by 6 months or 9 months to actually tell us that we were in a recession. So they're always looking in the rearview mirror. So we're not going to actually know we were in a recession until summer or fall next year. But it's very likely, based on this historical pattern, that we will be in a recession by first quarter of next year, if not already. So interesting information to note. Let's take a look at the rates here quick today before we go, at least the charts, right, of the mortgage-backed securities and the 10-year treasury. As you can see on the 10-year here, we've dropped back down. We were pushing 5% a couple weeks ago, which is high, right? That was really choking things. And that's dropped a bit to 4.6, which is helpful. Part of that is because we have started to see some weakness in employment data. We started seeing some more inflation, coming down. The inflation data the last couple of weeks has been easing a bit, and now we've seen the employment report, the jobs numbers come down, unemployment tick up. These things are starting to show weakness in multiple areas of the economy and improvement in inflation. So the market is looking at this going, well, the Federal Reserve is looking at the same data we're looking at, and they're eventually going to agree that they have gone too far, that they don't need to continue to keep rates high forever. Right now, we have no indication from the Federal Reserve yet that they are planning to ease rates or bring them back anytime soon. But as soon as they make that sort of projection or start to frame their comments and their press conferences that way, and their notes from their meetings, then the markets will definitely seize on that and try to be ahead of the curve, ahead of the Fed, by reducing rates, improving the bond market. So improving bond prices, which will reduce rates. So that's where we're at there. The universal mortgage-backed security has given back some of the gains. We had a wonderful last week. As you can see from last Monday, we were down here, kind of stuck at this Fibonacci level. And then unemployment reports came out, et cetera, throughout the week. And personal consumption expenditure reports came out, and a number of things were released that caused mortgage-backed securities to have a nice rally. So we gained all the way back up here because of these large gains. It's not unusual to see some of that give back the day after, especially after a weekend. So we're stuck now in a range here between the 50-day moving average and the 100-day moving average, and some Fibonacci levels. I don't know if it's going to break either direction. We might be here for the next few days. But thankfully, we had some nice gains in pricing, meaning interest rates on 30-year fixed mortgages came down a bit over the past week or so. So that's been welcome news. As we continue moving forward, like I said, if the jobs numbers are weak, unemployment ticks up in December for November again, we could see more improvements here. Inflation data, as that comes out later this month, we could see more gradual improvement in mortgage-backed securities as we move forward, which will help interest rates and hopefully help the mortgage market a bit more. So that is the update for today. Have a wonderful week.